Okay, let's carry on. So, this is the first TYU. It's pretty straight. They just want you to, I think, to calculate some ratios and then kind of discuss. But I think it's a good one to start with, just to build again your skill for reporting on this. So here they give you total production costs and gross profit. So you have to kind of work backwards and find out what I would do that, what the revenue was. So the revenue really must have been, of course, these two added together. So therefore you have this is 9,544,000, and here of course you have here 7,644,000, and now you can move. So the first ratio, of course, that I recommend you calculate is your gross profit margin. Your gross profit margin would be just literally this GP, right, divided by revenue. Pretty straight. So if you do that, you have 3,006 divided by 9,544, and that gives you a gross profit margin of 31.4. So I'm just going to write it here. I suppose GP margin 31.4 for X9, and here I'll just write the GP margin. So for X8, and I'll write that ratio here, its own version. Here would be 2,582 divided by 7,644, and here you would have 33.77. So I can see that my gross profit margin has fallen from one year to the next. Now here's the thing, there's so much you can go, so you can go in so many directions with this. I think, but it's important to recognize that gross profit margin is made up of revenue and cost of sales. So when you're discussing gross profit margin, you're really talking about these guys, aren't you? But you still want to talk about them from a numerical point of view. Really, the key point here is that this ratio has fallen. And what does that mean? So really, technically, right, if this falls, if GP falls, well, it means that either this stayed the same and this fell from one year to the next, or it means that for this to fall, either it means that this stayed the same and this increased, so cost of sales increased, right? Both of them. Or you have a scenario where, or you could have a scenario where this increased, right? But this one increased by more, so the cost of sales had a greater increase than the revenue. So I think it's just your way of thinking about it. Or in fact, this might sound totally ironic, but it's very possible that revenue, if you like, fell, but cost of sales fell by a smaller amount. So it's just watching. So if you look at it here, you can see what's interesting here, though, which is why you must always look at the individual picture, is that you do have an increase in revenue. So you should actually quantify that increase and say, oh, revenue actually increased by, and what does that mean? If you look at the percentage of increase, here you have 9,544, which you have this thing here, minus the 7,644, divided by the 7,644, because that's the increase. We're going from X8 to X9. Which is, so despite an increase of revenue of 24%, so you have an increase of 24%, the question is you must have had a greater increase in the production costs. You just must have, right, for the margin to fall. And you can test it. You can sort of find out what that difference is as well from one year to the next. And so let's do it, just because 6538 minus 5082 is equal to this divided by 5082 gives me a 28. So I see a 28% increase in my production costs. Now, I don't know what these are composed of, but the point is that, yes, I might have but we do generally expect when there's an increase in revenue or increase in sales for there to be a sort of joint increase in production costs. The whole aim is to make sure that revenue is increasing faster than production costs, right? That's generally the principle. So that is how you would explain your gross profit margin. Another way you could explain your gross profit margin is the fact that if we look at production costs, typically production costs will have because what is production costs, or when I say production costs, that's opening inventory plus purchasing minus closing inventory. So if there's a problem with closing inventory, so for example, it's possible, there's a fall here. It's possible that in this year, closing inventory was valued too high. If closing inventory is overstated, right, definitely your cost of sales will be understated, and therefore your profitability will be higher. Yes, that's the key point. So it might be something to investigate that, well, let's look at inventory on its own and actually see what's going on there. So, and we'll go to the answer and see the sorts of things they're talking about. So we have that. Okay, great. So, I mean, this is a screen, so I was going to clean all of this, but I'll keep it. Then here's my net profit. So my net profit is 590 and 574. So I can find those ratios as well. 590 divided by 9544, and I have a net profit margin, net PEEP margin of 6.18% here, and in this other option I have 574 divided by 7644, and I have a net profit margin of 7.5%. So I can see a fall in that. And of course, generally, this naturally feeds on from the gross profit margin. But what's critical, if you really want to discuss this, you need to talk about the operational expenses. And that's what's happening in between gross profit and net profit. So I need to find out, well, what happened between GP and net profit? Because that's really how we get to net profit from gross profit, isn't it? So I'm going to say 3006, which is what's happening here, minus the 590. Minus a 590, and I get 2416. So I can see that operating cost was 2416000. I'll do the same thing here. 2582 minus 574, and I'll have 2008,000. Now I said to you last time, the best way to look at this is to look at this as a percentage of your revenue. What percentage of revenue is this taking up? So when you do the 2416 divided by 9544, what you see is a 25% take up. 25% take up of overheads as a percentage of revenue. And let's do the same thing here. 2008 divided by 7644, and you see a take up of 26. Of 26%. Let me just do that again, because I was expecting this. Oh, sorry, who had a higher? Interesting. I was well, of course, what I have here is, let's just do that again very quickly, just to make sure I've got the right answer so I can interpret what's going on. 3006 minus 590 is 2416. 2416 divided by 9544, and I have a 25% increase, a 25% absorption of revenue. That takes that up. And then let me see what's happening here. I have 2582 minus 574, and then as a percentage of revenue, 7644, and that here is 26. So actually, interestingly enough, in this case, your operating costs actually absorb or take up more of your revenue compared to this one, which is a 25%. So to be fair, this is 25 points, this is 26 point. It's not so far off. But the reason why this keeps falling, and you can see the fall, think about it carefully, you can see that the fall here there's a difference really of 1% or 1.12%. That's because of the hurt already caused by the gross profit margin. The gross profit margin had already been hit by at least a 2% difference, 2-point difference, if you like, a 2% difference between just the gross margin. So although this has a higher operating margin cost, if you like, when I say higher operating margin, if I divide the operational cost as a percentage of revenue, it reduces it at least by 1%. So that brings this at least down to 6.18 versus this being 7.5 overall. So I think it's good to calculate that, and sort of I think the real argument here is that the gross profit margin was already suffering. So this just kind of softened the bump, so to speak. Here you can see, because you see this is 25. This is less than this. So this has softened this hit of 31, although overall it's still less, but now only less by 1%. So I would actually argue that in 2009 they better managed their operational expenses, but because they were already struggling with a lower GP margin compared to 2008, they still have a lower overall net profit margin. Okay, great. Now, that's that one. Then I guess the other ratios that we should really be thinking about, of course, are the asset turnover. So what we have here is that, oh, yes, so this was 9544, and this was 7664. So we can calculate the asset turnover. So this is just how well you have utilized those assets to generate revenue. So I have 9544 divided by 6011 here, and I have 7664 divided by 5722, and I can actually do that. So you can just calculate those two. 9544 divided by 6011, and I'm at 1.59, and here I have 7664 divided by 5722, and I'm at 1.33. So definitely here in 2009 they utilized their assets better, if you like, in generating income or turnover. Yeah, and I think that's about it. I think those are good enough ratios. Let's just look at the answers and just see what they're talking about. Let's just go here. Look at some of their discussions on this here. Okay, so you can see, of course, you would calculate all the ratios, and they've done all of that. There we are: GP margin, operating margin, return on capital employed, if you like, and the asset turnover, which we did, right? And they did that kind of work backwards. So profitability has deteriorated slightly, despite an increased turnover of 24.6, which we did. The GP margin has fallen by 2% from this to that. Perfect. Although turnover has shown a significant increase, production costs have increased at a faster rate of 28.7, which we did. The fall in gross profit margin may indicate, it doesn't really matter, a number of things. That key point is that you weren't able to sell as much, or you weren't efficient as in controlling your production costs, which we talked about by those when we played around with the arrows on the revenue and the costs. Operating margin. So again, the focus here becomes one on looking at operational costs. Again, despite an increase in turnover, operating margin has fallen from 7.4 to 6.18. Yeah, so we already highlighted, we actually broke it down better. I think we actually agreed that, well, we can see the problems feeding in from the gross profit margin sort of ratio as into the events leading to that figure of what it is, in terms of either lack of being able to achieve sales or not controlling its production costs, feeding into our operational area. But it says that indeed the operating margin falls, but not as much as the gross profit margin. So you can see, and we proved that. We actually looked at the operating costs as a percentage of revenue, and actually saw that. So in other words, non-production costs are a lower percentage of revenue in 2009, if you like. So really, the main cause is in the operating profit margin is the fall in the gross profit margin. Really important to be able to tease out the two, and you're getting better marks there. Asset turnover, improvement year on year. Of course, we calculated that. And return on capital employed. Yes, I don't think we calculated that. But the key point here, we would have calculated that. And we can see that this has fallen from 10.3 to 9.83. So it just really means this: how well is the company generating, if you like, for every pound invested, it's generating 10p, or for every £100 invested, it's generating £10, if you like. And of course, we could argue, again, this is net profit, isn't it, divided by capital employed. So we see a fall in net profit, and hence that would be enough. Although we could break it down and look at productivity times profitability and discuss it from there. But really, it's enough, really, by the time you've talked about the fact that the fall in net profit is the singular cause, or the main cause, because we can see that in this year, in 2009, productivity is higher. So if productivity is higher in 2009 and yet return on capital is lower, well, the cause really must be to do with profitability and not productivity. And you can round up that way, and I think that's a good way to round up those discussions. Okay, see you in the next video.